Why do you still pay $6 for a Starbucks latte? Why do people wait months for a Tesla? And why does a hot stock suddenly spike or crash? The answer is not in the charts. It is microeconomics. Today, I am unpacking the core ideas from Mankiy's economics textbook. Plain English, no dry definitions, just a chat between friends. Stick around, and prices will never look the same again. Let's dive in. Principle 1. Opportunity cost. Mankiw opens with a brutal truth. People face trade-offs. Want one thing? Then you give up another. Here is the key insight. The real cost of any choice is not the money. It is the best alternative you gave up. Picture this. 3 free hours this weekend. Work overtime for $200. Have dinner with your family. Or just binge-watch shows. Choose overtime, and the true cost is that family afternoon. Often worth far more than $200. Now apply this to investing. Say you hold $10,000. You could buy a hot tech stock, or earn 4% in a deposit, or kill credit card debt charging 18%. Buy the stock impulsively, and your hidden cost is that expensive debt. Beginners count what they lost. Pros count what they could have earned. Remember this line: the true cost is always the best option you surrendered. Principle 2. Marginal thinking. Rational people think at the margin. Margin just means a little bit more. Think of a buffet. First plate, amazing. Fifth plate, you are stuffed. One more plate has negative value, so you stop. Investing works the same way. Do not ask if a stock is worth buying. Ask if 100 more shares make sense at today's price. Here is a concrete example. A stock trades at $100. You own 200 shares. At $95, adding more makes sense. At 105, the value fades. Rookies go all in or all out. Marginal thinking keeps you flexible. Principle 3. Incentives matter. People respond to carrots and sticks. A $10,000 electric vehicle subsidy drops. Electric car sales jump. A company announces a buyback. The stock usually pops. Flip it around. Dividends slashed, executives dumping shares. Smart money reassesses instantly. Real-life version. Your boss never rewards overtime. Will you keep grinding late nights? Probably not. Change the incentive. Change the behavior. So when you see any policy or announcement, ask one question. Whose incentives just changed? And what comes next? Now the main event, supply and demand. The heart of microeconomics, the key to every market price. Demand first. Demand means how much people buy at different prices. Lower price, more buyers. That is the law of demand. Picture a cup of coffee. At $2, everyone buys, maybe twice a day. At $5, only loyal fans remain. At $10, almost nobody. Price up, quantity down. Now supply. Supply means how much producers offer at each price. Higher price, more motivation. Coffee at $8 a cup? More cafes open, more beans get imported. Combine both curves, and they cross at one point. The equilibrium price. Buyers and sellers match exactly. The market clears. Let's run real numbers. One artisan bakery in a small town. On the demand side, at $5, 200 loaves sell daily. At 6, 150. At 7, 100. At 8, just 60. On the supply side, at $5, the baker makes only 80 loaves. Margins too thin. At 6, 120. At 7, 160. At 8, 200. Around $6, the two sides nearly meet. At 7, buyers vanish while sellers pile in. A surplus. The market drifts back toward equilibrium. Now imagine this bread goes viral. Demand surges. The curve shifts right. Prices climb. The baker produces more. That is why hot products get expensive. Not greed, demand. Next, elasticity. When price moves, how much does quantity move? Insulin for a diabetic? Nearly zero elasticity. Double the price, people still buy. Bottled water? Highly elastic. $1 more, shoppers switch brands instantly. For investors, this is gold. High elasticity products like gadgets or fast fashion. A price hike crushes sales. Low elasticity products like software subscriptions or essential drugs. Price hikes barely dent demand. Bigger margins follow. So when reading earnings, do not stop at revenue growth. Ask how elastic the demand really is. Now the 5 traps beginners fall into. Trap 1. Chasing sticker price, ignoring opportunity cost. A $50 stock feels cheap, but that money might earn more elsewhere. Trap 2. Thinking cost only means money. Real cost includes time, risk, and foregone alternatives. 3 hours researching a junk stock can cost more than the loss. Trap 3. High price means expensive. Low price means cheap. Wrong. Prices reflect supply and demand. Hot sectors price high because demand is real. Cold sectors stay low because nobody wants in. Trap 4. Ignoring incentive shifts. Insiders dump shares, yet investors cling to the old story. Incentives changed. The story probably did too. Trap 5. Linear thinking. Demand does not scale neatly. Cross a psychological price point, and demand can collapse or explode. Finally, 5 takeaways you can use today. First, before buying anything, ask 3 questions. What is my real opportunity cost? Does buying more at this price still make sense? Did anything just change the incentives? Second, study a company's elasticity and supply dynamics. Is the product essential, easily replaced, hard to scale? Think chip capacity and brand moats. Third, read price swings through supply and demand. Long-term, prices track expectations for future cash flows. When everyone rushes to buy, the price is rarely cheap. Fourth, stay contrarian. When everyone's thesis is the same, incentives may already be gone. Fifth, make opportunity cost a habit. Every month, review your holdings and your time. Starting fresh today, would you make the same choices? All right, friends, let's recap. Opportunity cost, marginal thinking, incentives, supply and demand, elasticity, and the classic traps. Mankiw's core ideas are simple. People weigh trade-offs and decide at the margin. They respond to incentives, and prices are negotiated by supply and demand. Make these your mental filters, and every business story gets clearer. Investing is not guessing tomorrow's moves. It is understanding the economic logic underneath. If this helped, drop your take in the comments. Which principle will you use first? See you next time. This video is for educational purposes only.